my name is Aanchal Bhattacharya. We're living in interesting times, difficult times, uncertain times, and a time like no other in history. So then what's the big deal? Well, in every major epic, intelligent and well-meaning men and women have bemoaned the loss of prosperity and stability and have cried out, "These are truly epical times." And thus the human civilization took a turn from there. So in truth, time always remains vanilla. So welcome to the Vanilla Times. Today we have a very special guest on our show, as we'll be talking to Mr. Christopher Aiello. He's the managing director of Dynasty Global Capital. Chris is a contrarian fund manager, an iconoclast, a keen student of economic history, pragmatist, and basically someone who can explain very difficult things in very simple language. So Chris, thank you for coming and welcome to the show. Let's begin by talking about your experience in Japan and how you think Japan was a prelude to this monumental global economic and financial crisis that has perhaps only just started engulfing us. Why is the lesson of Japan so important to us? You know, despite all the talk, do you really think pundits, traders, and regulators have really paid proper attention to studying Japan?
Well, I think while attention has been placed on Japan, the lessons have probably not been taken seriously enough. The last 2 decades of Japan's deflationary recession and its long-term bear market and the volatility and cyclicality within its bear market, for me, are an analog and prelude to where the Western economies of Europe and the United States are headed over the next 10 years. I have the benefit of having lived in Japan for 5 years, from 1991 to 1996. And if I look at the progression of my experience there and how the Japanese psychology, the dynamics of psychology progressed. When I first moved to Japan in 1991, it was only 18 months after the Japanese credit and stock market and property market bubble had burst in December of 1989. So the Japanese were still filled with swagger and confidence, and their attitude at that time when I first arrived was that what they were going through was just a very typical inventory type of recession, and that the good old days of the 80s were coming back. But by 1993, I could really notice a major shift in the psychology of the Japanese business community, and I was running my own company there at that time. So I was really on the ground and experiencing the Japanese economy from the ground up. And around 1993, the Japanese really realized that something fundamental had changed and something fundamental had shifted. And in fact, the heady days of the 1980s were coming back. And by the time I was getting ready to leave Japan to come to Hong Kong in 1996, the Japanese had totally lost their zest, their vitality, and their attack in terms of business. And while I love going back to Japan today in 2012, and I do go back to Japan regularly for business, I love the culture, I love the food, Japan today is really a shadow of its former self. And I think that there are very important lessons there for the Western economies of Europe and the United States because of the similar policy decisions that they're making.
Alright, so what were the mistakes that the Japanese policymakers and bankers made that you see are being repeated again 20 years later, which makes you concerned that we are heading down the same road?
But if we look to the Japanese experience to extract valuable lessons from history, we can see some key things that they did in terms of denying the magnitude of the debt problem, which needed restructuring, an attempt to hide the losses, and a continuous policy to kick the can down the road to delay the inevitable of the need to restructure the debt. That type of behavior and decision making and policy decisions that the Japanese made 20 years ago, which we have a playbook that says it was definitely a failure and didn't work, is exactly the same type of decisions that policymakers, government policymakers, and central bankers, both in Europe in regards to the European banking and sovereign debt crisis, and to a similar extent in the United States are making today. So clearly the same decisions that were made in Japan 20 years ago, which did not work and produce economic growth, reduction in unemployment, and new wealth creation, didn't work 20 years ago, and it's not working today. I think it's Albert Einstein who said that the definition of insanity is doing the same thing over and over and expecting a different result. So I would say that our policymakers clearly have not understood the lessons from the history of Japan, and that to me indicates that the developed nations of both Europe and the United States are probably going to experience the same type of deflationary recession in very volatile and cyclical markets for at least another 10 years that we've seen in Japan in the preceding 20 years.
So how are the policy choices that elected officials and central bankers are making today going to affect the capital markets and the job of investing?
Well, the volatility that we're seeing in capital markets today is very similar to the volatility and cyclicality that we've seen in the Nikkei during its 20 years of its deflationary recession, as well as its 20-year bear market. The volatility we're seeing today in Europe, in the United States, and even here in Asia with the Hang Seng Index, I view it through the lens of being a psychological battle as the emotions of traders and investors swing between two bipolar extremes. On the one hand, there is an extreme of hope that things are getting better and that the decisions that policymakers and central bankers are making are going to make the good old days and the heady days of economic growth and sustain long-term bullish markets and asset markets continue down an upward trend similar to that we saw in 2003 to 2007. But things turn very quickly as we see this paradigm of the risk-on, risk-off trade, and then investors' emotions swing to fear that things are really not as good as the policymakers would like us to think that they are. So we're really in a psychological battle right now between hope and fear, and that's causing significant cyclicality and volatility in capital markets, which is the same thing we saw in Japan over its 20-year bear market period, very cyclical markets. For myself as a quant-focused trader who uses quant models to capture extremes in markets, the ability to short, the ability to use options to take advantage of this cyclicality, the volatility for me is opportunity. But for more traditional investors, which makes up the majority of the market, for long-term investors who have a buy and hold approach, this volatility is making their job very difficult because there is a lot of whipsawing, a lot of false breakouts of trends, and it makes making money in these type of very cyclical and volatile markets very difficult.
So that's very interesting, but based on your long-term view of financial markets history and cycles, how would you summarize the road ahead?
Well, if we use the lessons of history and the Japanese experience and project it into the future, if we look at Japan's 20-year deflationary process and its 20-year bear market, and the utilization of a decade of zero interest rate policy that the Bank of Japan used, I think it's fairly easy to say that the same policies that are being used in the West, particularly in the United States, are going to cause a prolonged period of subpar growth, and the decisions to not acknowledge the problems of the need to restructure excess debt and a desire to continue to kick the can down the road is actually going to make the problem worse. And more than likely, I would say that the odds or the probabilities are very high that we're going to have another major market dislocation that is even bigger than we saw in 2009 with the Lehman Brothers shock in the aftermath of the bursting of the subprime credit market bubble. If we look at what's happened in the last 3 years from 2009 till today, we can see that despite policies of quantitative easing 1 and 2 and various programs of Operation Twist, the United States and Europe itself are still experiencing below average GDP growth, stubbornly high rates of inflation, very volatile capital markets, both in the United States, Europe, and Asia. And very importantly, there's an entrenched recessionary mindset that has become embedded in the psychology of households, individual consumers, corporate decision makers, the leaders of corporations, and investors who are taking a very defensive approach to how they are utilizing capital and utilizing money. What we are seeing today is exactly the same type of behavior that we saw in Japan 20 years previously. So I would say that using the lessons of history and using Japan as both an analog and a prelude to the future, it is very highly probable that for at least the next 10 years we're going to experience very cyclical and volatile markets, below average economic growth, and a prolonged recession, because you cannot solve an excessive debt problem with more debt. That is the same thing as an alcoholic trying to cure his alcohol problem with drinking more alcohol, and it simply doesn't work. So until policymakers and central bankers acknowledge the seriousness of the problem that we have and acknowledge that debt has to be restructured and liquidated, these problems are going to persist. So I think using Japan as an analogy is really appropriate for where we are headed for the next 10 years.
So thank you, Chris, for coming down. I'm sure our viewers had an enjoyable session, and we'll see you in the next session.
Thanks very much. Enjoyed it.